So what do we think economics is about? Here's Wikipedia's definition. Economics is the social science that describes the factors that determine the production, distribution, and consumption of goods and services. The American Economic Association qualifies that. Economics can actually be defined a few different ways, they say. It's the study of scarcity, otherwise known as abundance, the study of how people use resources, or the study of decision-making. Economics often involves topics like wealth, finance, recessions, and banking, leading to the misconception that economics is all about money and the stock market. Actually, it's a much broader discipline that helps us understand historical trends, interpret today's headlines, and make predictions for coming decades. Underlying economics, so, is the question of what we really value. As with so much of what Wilde wrote or said, it's more than just a nice turn of phrase. It hits at the heart of the problems of society. Lady Windermere's Fan was written in 1892, but what Wilde wrote is even more true now than it was then. These days, our government, our businesses, our media seem to be dominated by what Wilde would have described as cynics. The idea that anyone in the real world should even consider ethical, moral, philosophical, or cultural values to be on a par with financial or economic value appears whimsical, sentimental, even romantic. Hard-nosed, sensible, rational, practical people know otherwise. It's the economy, stupid. Focusing on the price makes it easy to miss the real value, and can turn what should be complex decisions based on combinations of ethics, moral, culture, empathy, philosophy, and understanding of society into much simpler games based on numbers and calculation. The problem I want to address today is that there are two distinct meanings of value. Depending on the context, it can mean the importance, worth, or usefulness of something or someone, or it means the price or monetary value of something. Here are some related words to bring out the flavor of value. Valid, genuine, dependable, etc. Invalid, not so useful. Valor, bravery. And in French, valide, meaning healthy. I think we would agree that it is value that defines wealth and not the other way round. And Adam Smith, who's considered the founder of economics, used the word wealth as the foundation of his great work. However, here again, there is a double meaning. The word has been around for a very long time, and in the course of history has been used in many different ways. We talk about a wealth of meaning, a wealth of literature, etc., generally meaning a lot. But in economics, the term needs to be used with only one meaning, and unfortunately, because it's not, a great deal of confusion is generated. Now, beginning with Adam Smith, it has long been recognized that value has two meanings. Value in use, usefulness, and value in exchange, what you can get for it. For example, water has great utility value, but little exchange value unless it's corralled somehow. Whereas diamonds, particularly big diamonds, have great exchange value, but not a lot of practical use. Therefore, in economics, we have to stick to exchange value. Here's an example of real wealth. A Gothic cathedral built in an era when there was no stock market to store wealth. So it had to be put into real things of lasting value, like buildings. Crops are real wealth, giving food and life to people. But can you eat money? So articles of production are real wealth, generally have utility value as well, whereas spiralling property prices add nothing to real wealth. Real estate is actually the opposite of what it says. As we know, the values seem unreal. Was it Hitler who said that the bigger the lie, the more they'll believe it?
The word value, it is to be observed, has two different meanings, and sometimes expresses the utility of some particular object, and sometimes the power of purchasing other goods which the possession of that object conveys. The one may be called value in use, the other value in exchange. The things which have the greatest value in use have frequently little or no value in exchange, and, on the contrary, those which have the greatest value in exchange have frequently little or no value in use. Nothing is more useful than water, but it will purchase scarce anything. Scarce anything can be had in exchange for it. A diamond, on the other hand, has scarce any value in use, but a very great quantity of other goods may frequently be had in exchange for it.
Adam Smith's definition of wealth is clearly about real wealth. You can look at it in terms of annual production or overall wealth of a nation. And this is a much more precise definition of real wealth here. However, Adam Smith, whose patron was the Earl of Buccleuch, I'm not sure how you pronounce that, was and is the biggest landowner in the country. So Adam had different views from Henry George about land. Land, which in economic terms means all natural resources of the planet, was considered by George to be excluded from real wealth, which logically follows from these definitions. Adam Smith also counted land as one of the principal factors of production: land, labour and capital. However, Adam Smith and the mainstream economists who followed him have all counted land as part of wealth. So here there is an essential confusion in this inconsistency. I should briefly introduce Henry George to those of you who have not heard of him. He was an American journalist, not an academic, whose take on economics in his book Progress and Poverty sold more than 3 million copies, and that was a lot in the 1870s. His legacy is still very much alive today. His outstanding quality is as an original thinker, rather than just a compiler of other people's views. His mission was to find out the cause of poverty in the abundance of nature. So to recap, we've eliminated value in use as an economic concept. However, value in exchange can be split into value from production, that's to say the results of human labour applied to natural resources, and value from obligation. So value in production the value which comes from the exertion of labour in such a way as to save future exertion in obtaining the satisfaction of desire. Henry George's view was that fundamentally all wealth comes from exertion or work on natural resources. Natural resources are a given. Each individual has his or her work to contribute, and the result is the production of real wealth. So what is value from obligation?
The value which comes from the acquisition of power on the part of some men to command or compel exertion on the part of others.
Suppose you borrow £100,000 to buy a house. You have in effect pledged a proportion of the earnings from your future work to the bank. It's rather like a form of legal slavery. As the song goes, I sold my soul to the company store. The creation of debt or money through debt does nothing to increase real wealth, but it creates two assets. In this case, you have the house and the previous owner has the money. The bank has your promise to pay a proportion of your earned income over the next 25 years, and then some more. When something is sold in return for a promise to pay in the future, the money value of the whole system is doubled. There's now a debt which has value, say to the bank, as well as the goods delivered. There's more money now in the system, but the amount of real wealth in the system has not increased at all. So this matter of value from obligation is worth study. It's ruled by whatever the customs of the day are. One example is what happened when slavery was abolished. It was estimated that the value or price of all the slaves on the eve of abolition was $900 million. After abolition, that value almost disappeared, but the amount of wealth was the same. If you could count freedom as wealth, you'd find the total value to all the humans of America at the time had enormously increased. Clearly, for the study of the wealth of a nation, ultimately the important thing is the total increase of real wealth, real production, rather than money wealth. When any individual acquires the power to exclude others from a natural resource that they vitally need, as in monopoly situations, or keeping land out of use to drive up the price, or by patents, or by branding, giving them the power to command a price increase, this increase in value is by obligation without increase of real wealth, as Henry George expressed it. They have to exert themselves harder than they would otherwise. And here's a story to illustrate that. In the town of Abuja in Nigeria in the 1950s, no one could outwit the market women. They would buy up the harvest every year. No one knew where they kept it. Then out of season they would gradually release it, driving up the prices to the maximum people would pay. One day the local army commander came to them to buy food for the troops. Then the price asked was even higher. The commander went away fuming, promising he was going to break their power. He even threatened to send in his tanks, but the market women just laughed. He was furious and ordered his tanks in the next day to quell the women's power. But guess who had the last laugh? The tanks fell through the ground into the secret storerooms below the market, and that was the end of them. So this is what is meant by value from obligation. The women held prices up by the power of their monopoly position. Now, a modern version of this is Goldman Sachs commodity trading. They buy up the total harvest, wheat for example, of a whole region, and then drive up the prices out of season. So there's a big difference between the value or the wealth produced by the farmers and the wealth accruing to the women or Goldman Sachs by their withholding the same wealth. And here's why.
But in political economy, which is the economy of the society or the aggregate, there is a great difference. Value of the one kind, the value which constitutes an addition to the common stock, involves an addition to the wealth of the community or aggregate, and thus is wealth in the politico-economic sense. Value of the other kind, the value which consists merely of the power of one individual to demand exertion from another individual, adds nothing to the common stock. All it effects is a new distribution of what already exists in the common stock, and in the politico-economic sense is not wealth at all.
The important fact about this is that from an individual standpoint, money wealth, or value from obligation, is both real and important. Whereas, from the point of view of the nation, money wealth is something quite different and important only as a mechanism for the distribution of power. Let's just pause here to let that sink in. Have you heard the expression, money is power or wealth is power? I think we should begin to perceive money as a power, an energy like electricity. Electricity circulates as electrons in wires, and so does money. Electricity has positive and negative poles. Money has assets which are positive and liabilities which are negative. Money is created by dividing zero into an asset and a liability, and every unit of money corresponds to a debt. You might think of a financial transaction as an exchange of power, and the power to create money as a huge privilege. This analogy can take you a long way. So to recap, real wealth is what is actually produced, products and services. This is the annual way of looking at it, often used to compare different countries. And GDP is a sort of in-between measure, as it doesn't measure increases in assets, but on the other hand it does include all sorts of things which don't exactly add to the happiness of mankind, like nuclear bombs and prisons, for instance. This is the overall version of defining the national wealth. And you could see that money wealth includes lots of things which are only values of obligation to do with distribution of power. In theory, the assets and liabilities cancel out, but in practice, it doesn't take into account the pledges of future labour power, which make debts, particularly mortgage debts, a drag on the whole economy. Adair Turner is a highly intelligent man who's turned his attention to the problem of debt in his book Between Debt and the Devil. But here is an example of the muddle in current economic thinking.
Real estate accounts for more than half of all wealth, for the vast majority of increases in wealth, and for the vast majority of lending in all advanced economies.